Let me ask you something personal. When was the last time you checked your credit score? Last week? Last month? Never? Here is why that question matters more than you think. Right now, today, your credit score is either making you money or costing you money. Every single day. Whether you are thinking about it or not. Whether you even know your number or not. And here is the part that is going to stop you cold. The difference between a credit score of 620 and a credit score of 760. On an identical life, identical income, identical purchases, is worth approximately $200,000 over your lifetime. $200,000. Not because you borrowed more. Not because you spent more. Simply because one number attached to your name was higher than another number attached to someone else's name. That money does not disappear. It transfers. It moves from your pocket directly into the pockets of banks, lenders, and insurance companies who understood the system you were never taught. Nobody taught you this in school. Nobody explained it at your first job. Nobody sat you down when you got your first credit card at 22 and showed you the real rules of the game you were about to play. And that silence, that deliberate, expensive silence, has been costing you money every single year since the moment you became a financial adult. My name is Warren, and today I am going to break that silence completely. I am going to show you exactly how credit scores actually work. Not the surface-level advice you have already heard, but the hidden mechanics underneath that the banks understand and most people never discover. I am going to show you the specific invisible mistakes that are silently destroying millions of perfectly good credit scores right now. And I am going to show you the precise steps that move your score from average to excellent, and exactly what that difference is worth in real dollars on your mortgage, your car loans, your insurance, and your financial future. But first I need to tell you about Daniel, because what happened to Daniel is either happening to you right now or it happened to you already without you ever realizing it. Daniel was 29 years old, smart, hardworking, financially careful by any reasonable measure. He paid every bill on time. He never missed a payment in his life. He had one credit card that he used regularly and paid in full every single month. Daniel believed his credit was excellent. He had earned excellent credit. By common sense, he had done everything right. At 29, Daniel met the woman he wanted to marry. They found a home they loved. They sat across from a mortgage officer feeling confident and excited about their future. The loan officer pulled Daniel's credit score. It was 644. Not terrible. Not a disaster. Just quietly, invisibly, mercilessly average. And in the world of credit scoring, average is expensive. The bank approved Daniel's mortgage. Of course they did. But the interest rate they offered him was 1.8 percentage points higher than the rate his colleague James received the same week on a similar home. Simply because James had a score of 771. Daniel did not understand the difference. He signed anyway. The monthly payment difference was only $187. That felt manageable. But $187 per month over 30 years is $67,320. Daniel paid $67,000 extra for the exact same house as James. Not because he borrowed irresponsibly. Not because he missed payments. Because he did not understand the 6 hidden rules of credit scoring that James had accidentally stumbled onto years earlier. And here is what made Daniel's story genuinely painful. 3 months after signing his mortgage, Daniel learned what had damaged his score. It was not late payments. It was not debt. It was 3 specific structural mistakes in how he managed his credit. Mistakes that took him less than 4 months to completely fix after he understood them. He fixed his score too late to help his mortgage. But he fixed it in time to save himself another $43,000 on his first car loan, his refinance, and a decade of insurance premiums. The rules were always there. Nobody had shown them to him. Today I am showing them to you. Let me start by destroying the most dangerous myth about credit scores. Because this myth is the reason Daniel's score was 644 despite a perfect payment record, and it is probably affecting your score right now. The myth is this: a credit score measures how responsible you are with money. That belief feels completely logical. It is almost entirely wrong. A credit score does not measure your financial responsibility. A credit score measures how predictably profitable you are to lenders. Those two things sound similar. They are not the same. And the difference between those two definitions explains everything confusing about credit scoring. The system was built by lenders, for lenders using criteria designed to maximize lender profit. The moment you understand this, you stop trying to be responsible with credit and start learning to speak the language the system actually rewards. Here is what your credit score is actually measuring. 35% of your score is payment history. Pay on time, this stays healthy. Miss a payment and you take serious damage. Most people understand this part. This is the part they taught you. 30% of your score is credit utilization. This is the part they did not teach you. This single category is responsible for more unexpected credit score damage than any other factor, and I am going to explain exactly why in just a moment. 15% of your score is length of credit history. The longer your accounts have been open, the better your score. This is why doing something that feels financially responsible, closing an old credit card, is actually one of the most damaging things you can do to your score. 10% is credit mix. The system rewards you for managing multiple types of credit simultaneously. Cards, loans, mortgages. Lenders prefer borrowers who have proven they can handle complexity. 10% is new credit applications. Every time you formally apply for new credit, your score takes a hit. Multiple applications in a short window multiply that damage. Now stop and look at those numbers carefully. 35% of your score is payment history. You already knew that. You are probably already handling that correctly. But 65% of your score, nearly 2/3, is determined by factors most people have never been clearly explained. Utilization, history length, credit mix, application timing, structural factors that have nothing to do with whether you pay your bills and everything to do with how you manage the architecture of your credit. Daniel paid every bill on time for 7 years. His 35% was perfect. His 65% was quietly being destroyed by 3 structural mistakes he did not know he was making. Let me show you exactly what those mistakes were, because I guarantee at least 2 of them are happening in your financial life right now. Hidden mistake number 1. The utilization trap. And this one is going to change how you use your credit card starting today. Daniel had one credit card with an $8,000 limit. He used it for everything: groceries, gas, subscriptions, dining, travel. He paid the full balance every month, perfect payment record. But Daniel was consistently spending $5,200 to $5,800 on that card each month before paying it off. That means his utilization, the percentage of his available credit he was using, was running between 65% and 72% every month. Here is the critical detail Daniel did not know. Credit bureaus do not measure your utilization after you pay your bill. They measure it at the moment your lender reports your balance, which happens once per month, typically before your payment is due. So every month Daniel's credit report was showing a utilization of 65% to 72%. Every month. Perfectly on-time payment. Perfectly irresponsible-looking utilization. The threshold for excellent credit is utilization below 10%. Good credit is below 30%. Above 30% and your score begins taking measurable damage. Above 50%, the damage accelerates dramatically. Above 70%, you are in serious trouble regardless of your payment history. Daniel was at 70%. With a perfect payment record, getting punished every single month for being responsible with money in a way the system did not reward. The fix took Daniel one phone call and one habit change. He called his credit card company and requested a credit limit increase from $8,000 to $22,000. Approved in 10 minutes. His utilization on the same spending instantly dropped from 70% to 26%. Then he added one habit, paying his balance down to near zero 3 days before his statement closing date each month rather than waiting for the due date. His utilization on credit reports dropped to under 5%. His score jumped 61 points in 47 days, without changing a single spending habit. The system was never measuring whether he was responsible. It was measuring a ratio. He changed the ratio. Hidden mistake number 2. The one that feels responsible but is financially devastating. After Daniel graduated from university, he had 3 credit cards. Over the years, he stopped using 2 of them. They sat in a drawer collecting dust. He never used them. He never thought about them. At 27, he decided to clean up his financial life. He called both card companies and closed both accounts. Felt like exactly the right thing to do. Simplify, reduce clutter, act like an adult. That decision cost him approximately 40 points off his credit score in a single month. Here is why. When Daniel closed those two old accounts, he did two damaging things simultaneously and invisibly. First, he reduced his total available credit. Less available credit with the same spending means higher utilization. His utilization jumped from 26% back up past 40% simply because two cards he never used disappeared from his profile. Second, those two old cards were his oldest accounts. They were the foundation of his credit history length. Closing them collapsed his average account age from 6.2 years down to 2.8 years. Nearly half his credit history vanished overnight. A credit card with a zero balance sitting unused in your drawer is silently doing two important jobs for you every single month. It is holding your utilization down. It is aging your credit history longer. Costs you nothing. It earns you points. Never close an old credit card. If there is an annual fee you cannot justify, call the company and ask to downgrade to a no-fee version of the same card. Keep the account open. Keep the history aging. Keep the available credit working in your favor. The most responsible-looking financial decision Daniel made in 5 years cost him 40 points and $67,000 on his mortgage. Hidden mistake number 3. The one hiding in your credit report right now. This mistake is different from the others because it has nothing to do with your behavior. It is happening to you without your participation and without your knowledge. Studies consistently show that approximately 1 in 4 credit reports contains a material error. An account that does not belong to you. Payment marked late that you made on time. A debt that was settled years ago still showing as outstanding. A duplicate account inflating your apparent debt load. 1 in 4. If you are in a room with 4 people right now, statistically one of you has a significant error on their credit report that is costing them points they did not lose and do not deserve to lose. Daniel found 2 errors on his report. One account showing a late payment he had made on time. He had the bank statement to prove it. One settled collection from 4 years earlier still showing as active. Both were dragging his score down. Both were completely wrong. Both were corrected within 45 days of written disputes. The correction added 23 points to his score. You are entitled to a free credit report from each of the 3 major bureaus every year. Go to annualcreditreport.com, the only federally mandated free source. Pull all 3 reports today. Read every single line. Dispute every error in writing immediately. Most people never do this. The errors sit there for years. Quietly. Expensively, completely correctable. Now let me show you the real-world cost of everything I have just described, because this is the part that makes it personal. Mortgage on a $380,000 home over 30 years. Score of 760 or above. Interest rate approximately 6.4%. Total interest paid over 30 years, $463,000. Score of 640. Interest rate approximately 8.2%. Total interest paid over 30 years, $596,000. That is $133,000 difference. Same house, same loan, same 30 years. Different number attached to your name. Auto loan on a $38,000 vehicle over 60 months. Score of 760. Rate approximately 4.9%. Total interest $4,900. Score of 640. Rate approximately 12.1%. Total interest $12,800. That is $7,900 extra for the same car. Homeowners and auto insurance. Yes, in most states your credit score directly affects your insurance premiums. The average person with a poor credit score pays $1,100 more per year in combined insurance costs than a person with excellent credit. Over a lifetime of financial decisions, multiple car loans, a mortgage, refinancing, insurance premiums, personal loans, the total gap between a consistently excellent credit score and a consistently mediocre credit score is between $200,000 and $400,000. That is not a rounding error. That is a retirement account. That is a college fund. That is the financial difference between two people with identical incomes living completely different financial lives, simply because one person understood a system the other was never taught. Here is exactly what to do starting today. Not someday, today. Step 1. Pull your full credit reports from annualcreditreport.com right now. All 3 bureaus. Read every line. Dispute every error in writing. This single step has produced more surprise score improvements than almost anything else because most people discover errors they never knew existed. Step 2. Calculate your current credit utilization. Take every credit card you own, add up the current balances, add up the total credit limits, and divide. If your utilization is above 30%, this is your single highest priority fix. Pay balances down strategically, starting with the cards closest to their limits. Or call your card companies today and request credit limit increases. Either move lowers your utilization ratio and your score responds within never close an old credit card again. Never. Call and downgrade it to a no-fee card if needed. Keep it open. Keep it aging. Keep it working for you silently in the background. Step 4. Set every account to autopay for at least the minimum payment immediately. Payment history is 35% of your score. A single missed payment can drop an excellent score by 100 points or more and stay on your report for 7 years. Autopay costs you nothing and eliminates this risk permanently. Step 5. Stop applying for new credit in the 12 months before any major purchase, mortgage, car loan, business financing. Every hard inquiry in that window is working directly against you at the exact moment the stakes are highest. Step 6. If your score is below 620 and you are rebuilding, open a secured credit card or a credit builder loan today. Use it for one small recurring purchase each month. Pay it in full before the statement date. Your score will show meaningful improvement within 6 to 9 months of consistent behavior. Daniel implemented all 6 steps. Within 4 months, his score moved from 644 to 718. Within 11 months, it crossed 760. He could not undo the $67,000 his mortgage had already locked in. That number still lives in his loan documents, and he thinks about it occasionally with the specific frustration of someone who now understands exactly what happened to them. But his next car loan cost him $6,800 less than the previous one. His insurance premiums dropped $890 per year. When he refinanced his mortgage 3 years later, he negotiated from a completely different position and recovered approximately $31,000 of what his original score had cost him. The system was always there. The rules were always there. The knowledge was the only thing missing. And now you have the knowledge. So let me ask you the same question I asked at the beginning of this video. When was the last time you checked your credit score? If the answer is anything other than recently, if any part of Daniel's story felt uncomfortably familiar, then the most valuable thing you can do in the next 24 hours is pull your full credit reports, calculate your utilization, and audit your oldest accounts. Not someday, not this weekend, today, because your credit score is moving right now. It moved while you watched this video. It will move tomorrow, and it will move every month for the rest of your financial life, either working for you or against you, whether you are paying attention or not. The difference between paying attention and not paying attention is $200,000. Daniel learned that $67,000 too late. You just learned it in time. Now here is what I need you to know before the next video. Everything I showed you today is about the visible credit score system, the numbers you can track, the ratios you can calculate, the reports you can read. But there is a second system operating underneath your credit score that almost nobody knows about. A shadow scoring system that lenders use in addition to your FICO score, one that tracks behavioral patterns your credit report does not show. And it is affecting your loan approvals right now, whether your credit score is 620 or 780. In my next video, I am going to expose exactly how that shadow system works and the specific behaviors it is watching for right now in your financial life. If today's video made you feel like you had been playing a game without knowing all the rules, the next one is going to make today feel like the introduction. Subscribe to Invest with Warren and make sure you are there for it. I will see you in the next one.